Short sleeves are ready. Busy season has come to an end. This is the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an insurance partner at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, so we don't have a lot of topics today, but we do have three nice topics that came out. You've heard me talk about two of them over and over. It's from the FASB. Let's pump the brakes for a second. Let's stop for a second. Hold on. You're writing, you're doing something on the computer. Stop for a second and just listen to this. If you've issued a financial statement or if you're just about to issue a financial statement, hold on for a second, because the FASB finally issued ASU, Accounting Standards Update 2023-01, the first one of the year. And guess what it relates to? Guess what it relates to? Leases. Now, we've talked about this one in the past. I think Frank was even here when we talked about it. It's leases common control arrangements. Now, if you remember back, I think it was around November, I came out with that the FASB had put out an exposure draft on this, and then December we talked about it more, January talked about it more. So it's not that we're doing repetitive content, but we want to make sure you understand the importance of this. So if you're about to issue a financial statement, if you have leases between entities under common control, you have an operating company that you do the financial statements for, and they have a lease for the building, or it's equipment, or whatever else it is, but they're entities under common control, and there are leases in place or agreements or arrangements in place. Hold on a second. Make sure you look at this guidance that came out and make sure that you're putting this into effect. Because remember, the leases came out, the lease guidance came out and was effective for periods beginning after December 15th, 2021, which meant calendar 22. And we have a lot of nonprofit clients that are fiscal that are trying to do it now for the 6/30 year end. So if you do have this, because especially if people are going to go through peer review, or if these you're a company and you are preparing your own financial statements, you want to make sure that you consider this. So there's two pretty much areas that they focus on. The first one is the terms and conditions to be considered. Now, if you remember when the lease guidance came out, the first thing that they talked about, is there a lease? So because entities under common control are so interrelated and they can do certain things, they pulled out the requirement to analyze the legality of an actual lease. If there's a written arrangement and you have a lease, you don't have to determine the legality. If you don't have a written arrangement, you don't have to, generally you wouldn't have to go through and analyze if there is legality, but I still say, and the guidance does point to you this way, if there's no written arrangement, you might want to engage somebody to determine, is there still a legal binding agreement that creates a lease? The best way for me to put it, and this is just anecdotal, is that if I have an operating company that doesn't have a written lease with a real estate company, but the real estate has a mortgage, why there wouldn't be a written lease, I don't know. But if there was a mortgage, it's probably supposed that there is a lease, and the bank probably believes that there is some leasing arrangement. So there could be a situation where you have to get a third party, i.e. attorney, involved in the situation. But if there is a written arrangement, you don't have to determine the legality of it. That's the harder one. The easier one, which I'm happy that they came out with, I don't know why FAS 13 didn't think about this. That was the old lease pronouncement. I don't know why the FASB couldn't think about it. If you have leasehold improvements, what is the depreciable life of those leasehold improvements under the old method, on the old consideration? It is either the shorter of the economic life or the lease term. Well, all of a sudden, boof, the FASB says, instead of doing that, we could do the economic life of the related party. Oh, okay, I thought that was pretty obvious that we should have been doing that a long time ago, but they finally determined that if you have a lease with an entity under common control and you do leasehold improvements, you should depreciate those leasehold improvements over the economic life that the entity under common control uses. Now, if the entity under common control also leases that property from somebody else, they should be using the shorter of the lease term or the economic life. So pretty straightforward. If they're using 30 years and you have a 5-year lease, but it's an entity under common control, you can use the 30 years, okay? Here's one catch that I found really, really interesting. If you leave the property and there is net book value, the net book value is treated as a distribution. So if you have an operating company that's an S Corp, now I'm not Nicole DeRosa, this is not tax, don't report to her that I'm swimming in her pool or anything, but I just want to mention this kind of concept. If you have an operating company that's an S Corp, and you have net book value left, and there's a lease, the rental company or the lessor is an LLC, similar ownership but not the same, you do a distribution, the distribution has to go out proportional because it's an S Corp, but the LLC may have different ownership. So it can get a little bit hairy, so just keep that in mind. Okay, I emphasized about that. I went over that for a while, for over 5 minutes, but I want you to make sure, especially if you're issuing financial statements, please look into that and please consider that. Give me a call if you have a question. A couple other areas: investment in equity method and joint ventures and accounting for income investments and tax credits. This one is extremely esoteric. We actually have clients that are low-income housing tax credits, so I have brought this to the attention of some people in our office. But if you don't have people that have investment in tax credit structures, you don't have to really consider this, but you should look into it if you do. It permits an entity to elect to account for their tax equity investment using a proportional amortization method, assuming certain conditions are met. Okay? Now, the guidance is fairly straightforward as to what the conditions are. If you need to find this, you can look up, it's ASU 2023-02. Okay? They've only come out with 2 so far this year. I definitely think you should look over this. The other item that came out just recently is the AICPA has woken up. It says, it said 145, it actually says 149 just came out. It's special considerations audits for group financial statements, including work of component auditors. So they've been hot on this topic for a long time. The PCAOB's even talked about it, the group and component auditors. And now I know I have a lot of people here saying, I don't know what he's talking about. I don't audit any groups and I don't audit any components. Nope, that's not what we're talking about at all. In short, and a nice easy way to do it, if you do consolidated or combined financial statements, in essence, you are doing a group audit. It is a group of companies, okay? Some quick definitions. A group audit is the audit of a group of financial statements. I love the FASB and the AICPA, okay? A group audit is the audit of a group of financial statements. Audit define itself upon itself. A group auditor is a group engagement partner and the member of the engagement team other than the component auditor. Well, you don't know what the component auditor is. If we went alphabetically, you would know. They establish the overall audit strategy, they direct and supervise the component auditors, and they evaluate the conclusion. A component auditor is an auditor who performs an audit related to the component for the purpose of the group audit. Good thing I gave you that definition. A component itself is an entity, business, or a unit function of business activity or some combination thereof determined by the group auditor. I hope that's all very clear to you. So I'm going to try and give you a layman's view of this. If you audit a company that is a consolidated company and you audit the parent, you are the group auditor. Anybody that audits even one of the entities or one of the functions underneath is considered a component auditor. You have an entity in Roseland, New Jersey, where the New Jersey Society of CPAs is, but they have a subsidiary in Italy. That Italy company is a component, and so if whoever does that audit is the component auditor. Okay, you are the group auditor. Now, you could be auditing the company in Roseland, New Jersey, and they have all these little entities and subsidiaries right in Roseland, New Jersey. They are all components. You have to address this as part of your audit planning. You have to assess materiality properly as it waterfalls down from the group down to the components. It is a very deep area, and this is something that people can get caught on. Some of the changes It actually brings into connection the Systems of Quality Management Standards that came out a while ago. Remember 1 and 2 came out, and then they changed the SASs, and they also changed the reporting and accounting and reporting standards, the SARs, to marry up with the Systems Quality Management Standards. And I know after I went through this whole thing, this standard is effective for periods ending after December 15th, 2026. You're saying, okay, well, it doesn't matter. No, the component group auditor is still around even if you're under the current standards. They're just making changes. Some quick changes. It still retains the 2 operating reporting options. In other words, assuming responsibility, but now it's going to be referred to as being involved in the audit work of a component auditor. And also, it still allows you to make reference to the other auditor within your report if they've audited a component. So there's a lot more there to go through, but I just wanted to at least bring this information up to you so that you know that this is out there and you should be looking for, at least for this, but also if you are doing any group audits, you should be considering the group and component auditor requirements. Okay, so a few closing notes. There's some great upcoming A&A events. Frank and I will be presenting a 3-hour accounting and auditing update on May 12th with a replay on May 19th. The Audits of Employee Benefits Conference is on May 18th. That's a great session. Attend those sessions. The speakers there are super. There's a lot of good information. And of course, there's the NJCPA Convention and Expo on June 13th to the 16th in Atlantic City, which includes the only in-person New Jersey Law and Ethics course this year. Get the details and register at njcpa.org/events. Last but not least, be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.